For more on the Fed and how the markets have taken the central bank's patient stance, let's welcome Fifth Third Bank Chief Investment Strategist Jeff Korzenik. Jeff, great to have you with us. So first of all, this GTV chart on the Bloomberg showing the Fed funds rate hikes. Also, at the same time, we're looking at financial conditions that have really loosened dramatically since December. You see this huge bounce back there. So is the Fed being a little bit too sensitive right now?
I think Fed Chair Powell has really struggled with the communication strategy. Unlike past Fed chairmen, he does not have this long history as an academic economist, and that represents a challenge. We're simply not used to his communication style, and that perhaps he's overcorrecting now. We do think, however, that the Fed is acting appropriately, not just because they've tightened too quickly, but also because we think that the full employment mandate really hasn't been met. We're watching very closely labor force participation rates. They seem to be rising. That's a very, very bullish turn for the U.S. economy.
So then let's talk about where this does leave the Fed, because, of course, the step that Jay Powell took beyond where he'd already been was we might, in fact, ease, right? He's sending a signal that if market conditions deteriorate, we're ready to act. Does the bank have what it needs to do that? In other words, did it position itself, did it tighten enough that it's got the ammunition it needs in the event of a recession or some breakdown in Europe?
I think that is, they do have ample ammunition, at least with lowering Fed funds, and then there's things like reserve requirements that we haven't talked about for a long time. So they have the tools. But again, I would characterize this more as the Fed's shift in swinging pendulum between sending too hawkish a message to perhaps one that is now being interpreted as too dovish. At the end of the day, the Fed is going to do what it takes to fulfill their dual mandate, whether that's tightening or easing. I don't think that's changed at all over the last 6 months or even a couple of years.
And jobs day tomorrow, we're still expecting best payrolls gain since 2015. A bit of an easing from the stellar December numbers, but still pretty strong. You mentioned the Fed's full employment mandate. So when would that be met, and why are we still there?
Well, people have believed we are at full employment because we haven't been able to take the unemployment rate lower for quite some time now, and we seem to be stuck in a labor force participation rate sort of in the high 62, low 63% range. But when you look, traditionally, economists have long believed that a tighter economy and a tighter labor market would raise the labor force participation rate. It didn't happen. And we at Fifth Third were among the ones who argued that social ills, long-term unemployment, the opioid epidemic, and the incarceration recidivism were barriers. But what we now see is the business community shifting to solve these ills and hire marginalized workers, bring them back into the labor force. That could add years to this expansion.
You have a contrarian view on the possibility of an upside surprise on GDP growth, but also on where the jobs might come. Manufacturing, you see, as a sign of strength. How do you argue that?
Well, there's this widespread but frankly inaccurate perception that technology is net destroying manufacturing jobs in the U.S. The reality is, this decade, we've added net over 1.3 million manufacturing jobs, and it's been widespread. Basically, every subset of the Bureau of Labor Statistics manufacturing broad category has shown gains, and we see that continuing. That's really important macroeconomically. Manufacturing jobs have high multiplier effects, and they also offer paths to employment for people without traditional four-year college degrees.
All right, great to have your thoughts on this. Jeff Korzenik from Fifth Third Bank. Thank you.